This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! I know that here on the show we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. Well, welcome to a special edition of the Fintech Takes podcast. This is a very special edition because we are recording it from the Salt Flats outside of Salt Lake City. My name is Alex Johnson, and I am here with Colton Pond, who is the Chief Marketing Officer at LoanPro and a good friend of mine. I am out here because LoanPro is holding a special customer advisory board that I was lucky enough to tag along to. Colton, thank you for the invitation.
You're welcome. Yeah, I'm grateful. It's a nice flight from Montana, which is great. And literally out in the middle of nowhere in the Salt Flats in a desert.
Yes.
Hanging out and enjoying interacting with fintech executives has been awesome.
It's the best. Yeah. I mean, I never want to come to any event that's not this, basically, in the future. So you've ruined all events for me. Quite a beautiful podcast setup. I don't think folks who are listening to this necessarily will see the video, but it is gorgeous. It's a wonderful vista, and was so excited to get invited to talk about servicing, which is like my favorite topic. You know this is true.
I talk to Rhett all the time. Rhett Roberts, our CEO.
Yeah.
Like Alex Johnson's articles on servicing is imperative and the impact servicing has on the borrower. We were talking earlier about the impact that it has on cross-sell behavior and increasing share of wallet. How true is that to be able to build loyalty with your customer?
Yeah, no, it's crazy. I mean, I think I used the example when we were talking earlier about indirect auto lending, where it's like, especially in the future, I think, where there's more embedded lending that's going to be happening. A question I have is, what is the role of banks or other lenders in that environment? Because they're not necessarily going to control distribution the way that they're used to, right? And so, you use indirect auto lending as an example. Banks, credit unions, fintech companies, they are the predominant lenders through indirect auto lending channels, but they have a different relationship to customers because the customer didn't choose them, right? The customer is buying a car at the dealership. This is the loan that comes back. You accept it because you want the car. And then the question is, what happens next, right? And a thing that I've been told multiple times by different executives in the auto lending space is, we can't cross-sell to these customers. It's impossible. Like, our cross-sell ratio on customers acquired through indirect channels is pathetically low. And so a question I'm obsessed with, and I'd love to get your take on just like this and kind of the broader servicing imperative, is how do lenders change the standards and the experience and the way that they engage with customers, particularly when we're headed into this world where a lot of these relationships are indirect. A lot of these are like, this is the first time you're interacting with a customer. Like, what is the best practice there?
Yeah, so I think there's a couple of things. One, you want a servicing experience to work in the background seamlessly, right? You want no mistakes or mishaps where the customer has to call in and say, where's my statement, or why is this wrong, or what happened to my payment? And those are just like opportunities where you significantly lose trust, and an indirect model where you haven't even gained their trust from the beginning.
That's right.
The second aspect is, how are you there for borrowers in times when they need you to be there for borrowers? So one of our customers, Best Egg, I think has done an exceptional job at this through offering proactive hardship programs and repayment programs when someone loses a job or when someone is struggling to make a payment. The idea is, how are you there for them in a meaningful way? And then the last is, my viewpoint on it, especially in a consumer model, is people actually don't necessarily want to call in and interact. They want to engage in a way that I can self-service and I can get all the information I need and I can do the actions. And you need a platform that allows that. That allows the customer to be in control of their servicing experience themselves.
Well, so a bunch of things you touched on there that are super like passion points of mine. One of the ones that's really interesting is So during the COVID pandemic, one of the things that happened was lenders were really worried that everyone was going to default, right? And so they put all these programs in place. They had all these like hardship things set up. But the thing that was most interesting was they were prepared for customers to call in en masse without actually having had a problem yet. So it's this really interesting like test case of what happens when you have a conversation with a customer before they have an issue, but when you talk about something that they're worried about or something that they're anxious about, right? And I mean, you know this, like servicing is entirely a function of why are you calling? What problem can I solve? How quickly can I get you to go away? Like that's the way that servicing and collections and other things tend to work. But COVID was this really interesting example where we got to try out that not being the case. We got to try something else. And all of the banks that I talked to who kind of observed that process and saw how it went, they were like, it's actually kind of amazing to talk to customers before they have a problem, but to maybe give them advice on like, you might want to think about this, or we have this program that you might not have known about, but if you run into a problem, we'd love for you to take advantage of it. Because at the end of the day, like, we want you to make your payments. We want you to be financially successful. We want to work with you, right? And it's funny because this is how commercial lending works, right? Like in commercial lending, it's all bespoke. It's all like, hey, we need to come up with new terms. Yep. We had a slow quarter. We need to adjust this, blah, blah, blah. Like that's how commercial lending works. It's bespoke. It's personalized. It makes sense. But that's not how consumer lending works. That's not how small business lending works. But I think the point you guys have been driving home today is with the right technology, that can be how it works.
It can. I'll give you one really good example. We have a lender on our platform who has a big book of their business, their portfolio in Texas. So the last hurricane that hit Houston, that day that it hit Houston, all of their borrowers in Houston metro area received a text and an email saying, we want to be there for you during the hurricane. Click here to skip your next payment.
Yes.
No one had to call in, no one had to worry about anything. They clicked on that button, it automatically skipped their next payment, rescheduled autopay, recalculated interest, and the customer didn't have to do anything. Those are the experiences where customers are like, wow, that's awesome. You are proactively having my back in what I do.
Well, and I think the thing that you can then layer on top of that that's really interesting. I was in New York last week. You were too. Great to see you again.
Thank you.
And when I was there, one of the events I went to was the Nova Credit Cash Flow Underwriting Summit, right? And what was so funny was we were talking about cash flow underwriting. We were talking about origination, but organically in the conversations that came up all day on stage, people were like, but servicing. And to the point where like, I think Nova Credit's going to do a cash flow servicing summit next because like they were so excited about the ability to apply open banking and cash flow data to servicing because what it does, and I think this is really interesting, is it basically adds a layer on top of it, which is instead of a hurricane having to happen, where we know everyone in this geography has been affected equally, so we're going to make this one offer to everyone, which is great, by the way. That's a really important thing to do. But the future of this, from my perspective, is we know your individual situation because we see your cash flow, we see what's going on in your finances, and we have proactively tailored something to you specifically. So it's not a hurricane that hits everyone, it's a hurricane that hit you specifically, and we want to be there for you in a proactive way. And I feel like we're not that far away from that.
We're really not. And think about it on the opposite lens from a positive standpoint. Imagine someone that got a new job and now is making $50,000 more.
Totally.
You likely want to increase, and it's a credit card, you want to increase their line on that available credit because now they are a more worthy borrower.
That's right.
And you want to increase your relationship with them. Doing those things proactively. So many times it requires, with so many platforms, a borrower to call in. Like, hey, I got a new job. Do you think that you could increase my line? But the percentage of customers that don't think of that about that and as a result go get a credit card somewhere else and you lost the relationship. There's experiences both ways. And then in the negative side, where be there for your borrowers, a lot of our customers, when we talk about big challenges right now that they're facing, is they're worried about what's going to happen with credit losses and delinquencies. The CFPB released a report outlining that credit card balances are the highest that they've ever been. It hasn't yet hit credit losses in a significant way, but the signs point to it will. And it doesn't need to if you're there for them in a proactive way and you help them overcome challenges that they may be facing.
No, I completely agree with that. I mean, it's kind of a funny thing, but so much of this gets bucketed in certain operational responsibilities within a bank or a fintech company. And the way that sort of operational area is measured, what performance metrics it's held to, really affect the way that it works, right? And my favorite example of this is from a collections context, anyone who hasn't yet had a problem is called pre-delinquency, right? Which is such a funny term because like it really indicates that, oh, well, we don't really care to interact with you or have some type of like proactive conversation. We're just waiting for you to hit delinquency. And maybe there's a thing we can do to kind of adjust the odds of that happening. But it's really like we're waiting to see, like it's Schrodinger's cat and you're like opening the box like, oh, the poison vial's broken, the cat's dead. Like that's a bummer. You know, I mean, like it's a very weird reactive way to deal with it. Whereas I do think that proactive, just we're monitoring what's happening. We want to have that conversation with you. And it even gets into like, you know, speaking of like small things you can do better, one of the ones I was really interested in was just the idea of like being able to pick your payment date, which is such a small thing, but like the ability to pick your payment date can have such a huge impact on your cash flow, even on your willingness to work with a lender. Like we picked your payment date specifically. That's so important. And so I think there's things like that can be super valuable.
Or adjusting your payment date. You got a new job and now instead of the 15th, you get paid on the 20th.
Right.
Adjusting things like that and having flexibility for the borrowers allows you, them to know that you're there for them in a meaningful way.
Absolutely agree. Okay, so we could keep going on and on about servicing, but the benefit of being here in the beautiful Bonneville Salt Flats is that we get to talk to other folks who are here for this event. Colton, would you introduce our first special guest who popped on the podcast?
Yeah, absolutely. I'm excited for this one. Jeff, welcome. So Jeff is the CFO at Borrowell. I told Jeff we just met at this event, even though, one, I've known about Borrowell for a very long time, love the impact that you are making in the lives of consumers up in Canada, but two, I also told you this, I love your CEO, good person, making impact, and works extremely hard. So Jeff, welcome. Share one or two sentences on Borrowell and what y'all are doing.
Yeah, no, thanks for having me. So Borrowell is one of Canada's largest fintechs, and we try to help our members achieve financial prosperity by helping them understand credit, use credit, and build credit. We've got north of almost 3.5 million members, so we're quite large, and we're excited to continue growing.
That's awesome. I mean, you've been a part of all the conversations today. What's your take on just sort of like this imperative to approach servicing a little bit differently than?
Yeah, I think there's definitely a big opportunity there, and just before we went on, we were talking a bit about the mortgage space, and in an environment where rates have been so low, people were very quick to renew with their existing mortgage providers. But now with rates much higher, you're seeing a lot more, I'm going to shop around.
Sure.
Right. So I think, being able to deliver a really great experience on onboarding and servicing, in addition to, good rates, is going to be a bit of a differentiator. So I definitely see that as a competitive advantage going forward, even though it's probably been overlooked for a while.
Yeah, I completely agree. Jeff, talk a little bit about consumers' expectations right now. First, the consumer set that you serve, and then what are consumers' expectations? I saw some product innovation you'll have on reporting repayments and increasing credit and things along those lines. What are you seeing from consumers' expectations when it comes to credit and lending?
Yeah, so in Canada, things tend to move a little bit more slowly. So we, earlier days, most of our engaged members were in the near prime and subprime space because we had really active partners who were trying to acquire there. And, we really, built a big business working with that consumer set. And as we've grown in scale, and we onboard members across the credit spectrum. So if you look at our, 3.5 million members, they don't skew subprime. They're representative of the Canadian population. Mm-hmm. But, those prime users on our platform weren't really, doing as much because there wasn't as much of an offering for them. But as we've grown, we've really made inroads into the big banks. And now we're doing a lot more with the big banks and surfacing them to our prime users. And what that's allowed us to do is really work with the banks to help them improve their digital funnels to be more competitive. They're all trying to win business from each other because
sure.
Canada, like many of developed countries, it's not growing very fast.
Mm-hmm.
So the way you grow is by taking share from others. So they're starting to leverage Borrowell as a key channel to originate new customers from.
So do you see in Canada, I've tried to become a bit more of a student of other markets besides the US, but in Canada, do you find that like there is an appetite on the part of big banks to work with fintech and engage with fintech?
Yeah, we're seeing that a lot in our position, and it's taken time to get there.
Sure.
Right. So, one of the things that we've started to do with big banks is they're now more open to share more of their underwriting on the credit card side. So we can surface pre-approval offers to our user base, which has helped them, grow originations on our platform. When we go live with an integration like that, volumes increase 10x in a month that we're driving new business to their cards. So, that story is very compelling going into the next bank to say, look what we could do for you. We're a very targeted channel. We have all the credit data because we pull credit reports for all of our users. So they are open more and more to innovation. And we've got a couple of banks as investors, and they've been really great to partner with, and they're getting better every day.
I love that. One of the aspects, there's several aspects that are unique about Canada. We're talking about banks, right? Canada's unique because you have big 5 banks. I like to say 6 because I know that you were at National Bank, and I love the team over at National Bank tremendously. So we'll call it 6 because they're up there and they're doing some cool stuff. But help us understand unique aspects when it comes to a big theme here has been kind of headwinds and tailwinds within lending and credit. What do those look like in Canada from what you're seeing?
Yeah, in terms of, I think for us, we think a big tailwind is, again, penetration in a platform like us, and churn within the Canadian consumer market has been historically pretty low. So what we're trying to do is really enable customers to see the options that are out there and create more churn in the marketplace. So allow banks to compete better against each other. One of the things that we've done is we've worked with one of our partners to launch, a new loan aimed towards prime users because we saw a bit of a gap in the marketplace. So we worked with them to launch a brand new product, and that's been a great product for them. It's a prime loan, and we just want to do more of that, like surface areas that we think are underserved, and working with partners to develop products to go after those markets. So that's definitely been a tailwind for us because of all the data that we have and all the engagement that we get, and it opens up opportunities for the banks to acquire new users and maybe sectors they haven't really focused on in the past. In terms of headwinds that we're facing, where we, in addition to having a marketplace, we also have a couple of subscription-based products on the credit building side, and what we need to make those products work better is better, integrate or linkages with, the types like Plaid, MX, the open banking infrastructure is, very far behind in Canada. I mean, we talk a lot about it a lot on the regulatory side, and it is coming. It is coming. But as a smaller fintech, it's trying to manage the, regulatory oversight that the banks want, but maybe not realistic for a smaller fintech to adhere to. So those are the things we're facing. We try to get very involved in those discussions at the regulatory level with other fintechs to make sure that we have a voice at the table, to make sure that whoever gets put in place in terms of that regulatory environment is friendly for fintech, so that we can continue to innovate and participate.
Well, you've definitely made your voice heard, because I have written about open banking in Canada several times, largely driven by the voices of fintech in Canada who are like, be nice to move a little faster, be nice to have rules that are a little more friendly to everybody. So keep it up, because it is definitely, I think, making an impact. The other thing I wanted to ask you about is, speaking of sort of underserved opportunities, talk to us a little bit about credit building in Canada and how that works, because I'm obsessed with that topic, but my lens is very US focused. So like in Canada, how does that work today? What's changing?
Yeah, so I think in terms of credit building, I think what we've seen in the US, or at least us looking into the US, is it looks like it's a much larger market than many people originally anticipated.
I think that's true.
Right, so I think we're trying to push the same case in Canada, and we actually got into the credit building space by acquiring a company back in 2021.
Oh, interesting.
That offered credit building loans and a secured card. So we acquired that company, and we kind of innovated on some of their products brought them into the Borrowell umbrella, and that has become our kind of subscription business. So today we offer a credit building installment loan, and then we also offer a rent reporting service for Canadians to report their rent to Equifax without landlord involvement. And we think those are great, and we saw actually our federal government back in March of this year, our Prime Minister made an announcement to say, innovations like rent reporting are very important to help get Canadians that credit for paying rent all the time, because that's a significant expense every month, and they're not getting credit for that on their credit report. So he came out and he made a speech to say, yeah, this is going to help make things more fair for Canadians. So that was a really great boost for us, and we continue to see innovation in the credit building space, and we look to the US to see, hey, what are some products that are working well there, and can we bring those up to Canada?
I'm glad to hear that you're learning from both the good things and bad things that we're doing in the U.S. That makes me very happy. So hopefully your experience is a little smoother in some ways.
Yeah, I think for us, we just want to make sure that, we've seen the bad examples where, there are artificial credit building products that really are not indicative of someone being able to make, regular payments and really be a good credit risk. So we're definitely trying to avoid those.
I've made it my mission to destroy those, so I appreciate that.
We want a product that is very reflective of, payment history and allows people to demonstrate that they are good borrowers. Our goal is to not have people in our credit building products for very long, but to graduate them to a marketplace, because people don't come to, grow their credit score. They're coming because they want to get access to a product that they couldn't before. Right?
Sure.
So they couldn't get that unsecured credit card, or they couldn't get that loan because their credit score was too low. So we want to basically enable that pathway to get onto those products.
Yeah, love that. And I think that's the whole premise of, my view of Borrowell, and also the fintechs that I view out there that are truly making an impact, is how do you help people grow in their financial lives when, I don't know the stat in Canada, I'm sorry, but 7 out of 10 adults in the U.S. cannot afford a $400 emergency expense. I would assume similar in Canada, right?
Very similar.
And there's a huge need for people to come in. How do you help people grow and build their credit, grow and build their savings in a really responsible way that has an ability to make a huge impact?
Yeah, no, that's definitely been our mission since day one, really.
Yeah.
We've pivoted a little bit along the way, but that guiding mission has always been ours at Borrowell.
So what's next?
Yeah, I think for us, we think there is still a tremendous opportunity to do more with our existing partners. Canada is still fairly underpenetrated from a free credit score perspective. And again, we can continue to do more with the banks. And we think there are other opportunities to launch more innovative credit building products.
Sure.
Not only report rent, but other types of payment history into the bureaus. So I think for us, what we realized is in Canada, you can't just be one thing. You've got to kind of do a lot, because the market is a bit smaller, but the opportunity is still very large, because our financial institutions are very, very profitable. And we just want to create more competition within that. And we think we can be that enabler, really creating more choice in the marketplace in Canada.
To that point, Alex, we've been talking about it, but I think that's a general trend, right? If folks are realizing both in broader financial services, you can't just offer one product.
Yeah. And
you need to drive increased cross-sell, upsell, share of wallet opportunities in a really meaningful way. And we chatted earlier how servicing is a really unique ability to do that.
Yeah, I think rebundling is kind of key to this whole value proposition. And we talked earlier about this idea that you don't always have the right to win the next thing with customers, right? And I would imagine for you guys, particularly from a marketplace perspective, I'm sure you're very thoughtful about what's the right product for the customer, which providers have the right to win with this customer, what's the best fit, and being very thoughtful about that, because I think one thing I've seen a lot in the US with some of this stuff is when you're not thoughtful, you tend to get sort of eaten by your business model or whatever your incentives are. And so if you're not careful and thoughtful about that, it can tend to go in a direction that is rebundling, but rebundling in a way that's not necessarily best for the customer, which is kind of the opposite of what we're trying to do, right?
Yeah, no, we see that, and we've got thousands of conversions a day happening in our marketplace, and you can really see which partners do very well in their onboarding process, and that's something that we make a point of sharing, right? Because helping our partners get better helps them get better and grow. So that's it's a very two-way relationship that we have with our partners, and we love sharing insights and helping the whole ecosystem get better at acquiring customers and keeping them.
Yeah. Well, one of the aspects I love about what you said is increased competition up in Canada, because it has been, I'm going to say 6 once again, the big 6, right? And increased competition always drives greater products for the end consumer. So Jeff, thank you for joining us and coming out the Salt Flats and hopping on the podcast to chat a little bit about lending credit.
Well, thanks for having me.
This is awesome. Okay, well, we're keeping it rolling. Colton, you want to introduce our next guest?
Jared is one of my favorite people in the industry, but Jared is at Moov, one of the early team members at Moov, leading the innovation over there with Wade and the other folks. Jared, give a quick intro yourself and 1 or 2 sentences on Moov. Everyone should know Moov by now with the things y'all are doing.
I hope. My job will be a lot easier if they do. My name's Jared Jones. I lead sales and partnerships at Moov. Been there almost 4 years now, and what Moov is a payment platform built for developers and technology companies that want to accept, store, and send money however they want with one API.
I love it. By the way, I tell people this all the time. When I think about companies that are named perfectly, there's no one better than Moov.
Oh, that's great. I'm sure Wade will love that. I have problems with the name.
I think it perfectly says what you do. I love it.
I will say I ranked you guys very highly in my ranking of fintech logos, which was a very controversial piece, but you guys did very well.
I saw that. We took it very seriously.
Well, I appreciate that, because I put more time into that project than I probably should have. I do have a Moov sweatshirt that Wade sent me, so all in on Moov as a company. Give us the connection to loan servicing and lending and credit and all the things you guys are thinking about there.
Yeah, absolutely. So right now in the space, obviously it's evolving very rapidly.
Yeah.
We're doing a lot of different things. So we're actually an acquiring processor. We're also an issuing processor. So we kind of run the gamut. We give companies like LoanPro ultimate flexibility with what they want to do, regardless of whether that's collecting or sending money, issuing cards. It doesn't really matter.
Yeah.
What we also can do is a few kind of little special magic tricks underneath the hood with interchange. And so with products like debt repayment, we can actually offer up some really competitive fixed interchange rates when you're leveraging Moov's debit rails via some of the programs that we offer. And so most people traditionally are used to paying back their loans via ACH, link up a bank account, but as we modernize, people are going to be looking for new and flexible ways to do that, and businesses are going to be looking for cheaper ways to do that, and we're offering up some ways to do that with them right now.
Yeah, and I think a big aspect there that you're hitting on is solving the job to be done or the need that both consumers and businesses had, and one of the aspects we've been talking about is how those are different in a lot of regards and what those look like. Help us understand payments when it comes to, from a lending credit perspective, with consumers and businesses and some of the pain points that exist today.
Yeah, so on the consumer side, we see this trend. People want ultimate flexibility, digital first, mobile first. So businesses need to meet consumers where they're at, especially like Gen Z. I was in the car earlier talking with folks, should we have Zelle baked into our app? And I'm like, well, it really depends on who's actually your end user.
Who's your app for,
Yeah. Oh, my 22-year-old daughter is actually my target demographic. I'm like, well, maybe it's Cash App, maybe it's Zelle. I'm not quite sure which one it is. On the B2B side, it really is about meeting the need of what that credit need is. And that can come in all kinds of different ways. So I would say right now, what we're seeing is, on the debt repayment side specifically, it's just about getting it faster. People want better onboarding experiences, so a push to debit experience to actually push funds back to a bank account, or an RTP type experience. So speed to paying back the debt on a credit installment is really important, but also the onboarding experience for the user to actually get back into that payments platform to hook up their actual destination accounts. I think that's really big. So those software experiences matter. They matter big time. And so I think those are some of the trends we're focused on.
So a thing I'm constantly sort of obsessed with, particularly as it relates to payments, is just when we're going to get things that are sort of like you can glimpse them out on the horizon, but you can't quite reach out and touch them yet, particularly as like a consumer. I mean, we all have these experiences where we're used to paying bills a certain way or like money moving in a certain way. But when you think about, from your vantage point, talking to all the companies that you talk to in the space, when you think about faster payments, when you think about pay by bank, when you think about some of these things that are sort of out on the cutting edge that might change the way that some of these payments happen, what's kind of top of mind for you? Like what things are sort of highest up on the radar?
Yeah, I think on that horizon, I really do think it's about, it still comes down to the user experience, whether that's the business or the end user. So we offer up a lot of optionality. Our customers sometimes get lost in the sauce trying to figure out, do I want slower money in or faster money out? How do I monetize these opportunities? But the truth is that if you're providing the best and ultimate kind of end user experience for your businesses, your consumers, in the actual digital footprint that they're experiencing, I think at that point it becomes a lot easier to figure out how to monetize. So I think the two things that are really important for us are, how can we really understand holistically what your end user needs so we can tailor a payment solution or experience for them that matters most, that's elegant, seamless, fits right into their life. And then second, how do we help you make money doing that? And so there's lots of different ways to do that. Right now, what we see is kind of the businesses being really interested in or comfortable with fronting the funds, like the cost of getting funds into the platform. Like if we can do that instantly, we're happy to pay $1 per transaction for our consumers to actually fund faster versus having to wait 3 or 4 days over an ACH. But on the money out, well, one, we want to hold it. We want to find interest bearing. On the money out, we want to monetize. We see Venmo and folks doing 1.75% on an instant payment out. How do we get some of that, on the money out? And so we're figuring out really creative ways to help businesses monetize their money out solutions, but also give them access to get the money in faster so they can create higher interest bearing opportunities for their products.
Let's pause real quick. Well, this car passes.
Thank you for that.
I know.
I'll edit this out. We're gonna go right over our cord. Like what the?
Hey guys. Good to see you.
That was.
I assume it's still plugged in.
Yeah. Okay. We've got power. Everything's okay.
Okay, good.
I better double check the. No, everything
There's
was
so much
fall apart.
space in the salt flat.
All of this space.
I know, and you want to go right in front of the golf club. It's crazy.
You have people who are going right there. It's like, what are you doing? Okay.
So stupid. Okay.
Good.
Sorry.
You want me to clap?
No.
Okay, good. So, Jared, I want to take a slight detour.
Sure.
And when I was thinking about, we're friends, right? And when I think about your background, one of the unique aspects about your background is you were in healthcare, you were at Kaiser, you were in the developer experience at companies like GitHub, and now you're in fintech and payments at Moov and really deep in there. Think about those three industries are all very unique. But I believe that fintech has things to learn from healthcare and from developer experience and what that looks like. Help us understand your perspective there and insights you take on a daily basis from your experience into fintech.
Totally. So you're right. I have been blessed with a really rich, diverse set of experiences, all in software, all in technology. I had this really perverse love of fintech. It's I was in it once before and it sucked me back in. I couldn't stay away.
It's okay to admit that on this podcast.
Okay,
That's fine.
it's this weird soft spot. I just can't get rid of it. But one of our board members, Angela Strange, she said that every company is going to become a fintech company.
Sure.
And it's hyperbolic in a sense, but it's actually true. And I think that my experience, when I look back, I can see just exactly how challenging each one of the buyer profiles, the consumer profiles, people paying for radiology tech or Cerner, they're used to net 90 or whatever it may be, and invoicing in a certain way. Who's fronting that bill in the insurance world versus in developer experience? These guys don't care about cost centers. They care about speed to market. And so there's you probably couldn't get a profile from a developer buying software to a healthcare professional paying an invoice for, $1 million radiology machine. You probably couldn't get a further apart profile, but they all have the same need, and it is access to capital, and they need these things solved very quickly. So I think what it allows me to do is to take a really holistic approach to my customers, my partners, and zoom all the way out instead of trying to put them in a box and say, hey, you're a lending company, you need X, take this off the shelf and go buy this. Or you're a developer, so you must want this programming language. I get to show up and go, hey, I actually know enough to know that I don't know everything about your actual experience. Let's take a little bit longer to understand what solutions might work better for you than someone else in a different industry. And then let's tailor, because we have a platform, let's tailor those solutions and those payment experiences directly for you. So a click back, taking a little bit of time up front, being technically empathetic to the buyer in the audience in that process, I think allows us to create more holistic payment experiences for our customers, and it doesn't make us force them into a single pathway or a single product.
Well, that ties with embedded lending, as we were talking about embedded finance earlier and what that looks like, right?
Yeah. Well, it does bring to mind an interesting question for me, which is, and this is me sort of putting on my old marketing hat and sales hat a little bit, but I am really curious on some of that stuff, how you guys kind of split the difference a bit between the you can do anything and the, hey, tell me what to do, right? And I used to run into this all the time where it's there are certain buyers that want a prescriptive solution where you tell them this is the best practice, this is what you do.
Yep.
I always had the impression from the outside of Moov that it was much more of a we're going to get close to the metal, we're going to enable you to do a bunch of stuff, but here's all the options, go nuts. As you guys have matured, how have you sort of finding a balance between those two? Because sometimes you have developer buyers, sometimes you have business buyers, it changes.
Totally. And we will always have both of those buyers.
Yeah.
We found a tremendous amount of success in these kind of protracted sales cycles or partnerships with, dare I say, legacy fintechs. Really important providers like Jack Henry, where we're embedding our solutions with them. But it is a multi-year, long-term relationship. And probably the most important thing we've done to date, relationship we've fostered. Mm-hmm. Super important, but you have to take a very long time horizon with a relationship like that. 18, 24 months out, then maybe you start to realize some of the value and the end users start to see some of the goodness and the innovation that you're bringing. You have to have those to kind of lift the boat up and take it along, this long journey. For customers that come in that maybe are a little bit, that need solutions that are a little bit more turnkey or right off the shelf, and if you don't have those, that's okay. There's a short checklist. Do you have developers on staff that can actually build products with APIs and SDKs? Do you have the penchant to actually go down this journey with us? And then 3, do you look like one of anything like another customer that we have, where we can say, hey, we've got a flow of funds, we have a prefab solution that we've already done with someone else. Does this kind of resonate with you, this use case that you're trying to fulfill? And it never is, again, one for one, but at least they can go, I'm inspired by that. I actually there's some prior art here. I believe that these guys can do it for me because they've done something very similar with a competitor or a partner. Now we can go. If you don't fit into one of those 2 categories, it's probably not going to work, especially with a team that's really lean that we have. So that's kind of how we walk that line. Big time horizons for big strategic partners that we know we get it right, we can go off into the sunset. And for smaller partners, if we've done it before, let's figure out how to replicate that flywheel for partners that maybe we don't have an off-the-shelf product ready for.
Yep.
I love that. One of the key tenets that ties into that we're hearing a lot from our customers who are lending organizations and those that offer credit cards is simplification. And there's an element here of how to simplify experience while still bringing the best-in-class technology together and what that looks like. Talk to us a little bit about driving simplification within payments and what that looks like and how to drive that forward.
Thank you for the softball. It's why we built Moov. How we built Moov was with open source. That was the origin story of what we did. Wade built, an ACH gateway, built a Metro 2 library. Now I think we have 56 different libraries that are all open source on GitHub. But really, sorry, I just lost my train of thought.
No, you're good.
Back to your question.
Simplification
Of the platform. We decided that in this journey of trying to put open source in front of people, we realized this is way too complicated, and no one actually wants to go rebuild all of these different things and commercialize it. So we took those open source libraries and we built an end-to-end payment platform, card acquiring, ACH processing, a ledger, instant push to card, RTP. We built all of those things with one API. So what we hear from our customers is, man, it's really complicated to understand how to build with you guys, but actually building the integration, is the simplest thing I've ever done. And so we get technical buyers, engineers, product managers that come in, and they stand up an end-to-end payment solution in 3 or 4 days with one API. And the beauty of that is now it's time to market, right? They don't have to go ask their engineering resources for, a gigantic team. They don't have to go do due diligence on 5 or 6 different categories of different vendors or providers and then stitch those things together. So we really did set out to build something that was end-to-end simplification of payments, which is an incredibly complicated field in its own, and abstract away all of the different primitives, the AMLs, the BSAs, the bank sponsors, and just put it all into one platform with one API. It resonates deeply. Now, scaling it and getting customers to actually derive the value that we've promised out of them, that's our next challenge. But the actual vision and the actual integration and standing up and actually moving money, really simple with Moov, and that's why we exist.
Jared, before we let you go, you guys also are involved in a event that's one of my favorite events. Plug that event, sir.
I unintentionally wore it, but I guess I'm wearing it for good use. Fintech DevCon is it's Wade's brainchild, but really it's our event. We do it every year. It is not a customer event. It's not a user event. It's certainly not a sales event. It's not Money 2020.
It's really not.
Not at all.
Yeah.
A bunch of software engineers and developers.
We love Money 2020. We love Money 2020, but we really do say, okay, like, how can we achieve kind of the greatness of that event on a much smaller scale, but be the opposite of that?
Yeah.
And so really what it is, it's a community event, and we built it for the builders in fintech. If you are a technical founder, or just a founder, a product manager, a software engineer, a DevOps practitioner, it doesn't matter if you're at a bank, if you're at a lender, if you're at a fintech, if you're Alex Johnson, if you're building something interesting in fintech, we want to hear from you. The general premise I tell folks, I'm like, how do I do a talk, or what should I be thinking? It's like, how did I screw up something I built in fintech, and how did I not screw it up like me? That talk always hits every year. And so if you're building something in fintech, we'd love to hear from you. We have a call for papers open now. Happens in August. We'll be in Denver, and we'd love to see anybody building interesting things there.
Awesome.
Yeah.
Well, Jared, thank you for coming. Thank you for coming to the Strategic Advisory Board.
Thanks for having me.
Chatting with Alex and I. It's an absolute pleasure.
Cool. Thanks for having me, guys.
Thank you. I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com. Okay, we are moving on to our next guest. Colton, give us an introduction.
I'm stoked for this one. One, Nick is one of my favorite people. He already knows that. But two, one of the people that truly, last night Nick got an award. One of our values is to understand being the details. Nick and the entire team at Happy Money, extremely in the details and innovating in a really meaningful way. I know a lot more about Nick's background because 3 years at Happy Money as head of product, 5 years at Goldman, very loyal. I love that. Nick, give us a little bit of an overview of what you're doing at Happy Money and the impact that y'all are having.
Yeah. So at Happy Money, right now we're working on. Well, we can do this as many times, right? Or
of course we can.
Yep. 8.5, man. At Goldman.
Was it 8.5?
Yeah.
Let me flip back. 8.5 and then 3.
4. 4 at Happy Money. Yeah.
Okay. All right. Let's. You just go with the introduction right away.
Great.
All right.
8.5 at Goldman.
Yeah. I mean, it's like an eternity there. So,
that's a long time.
Yeah.
How long were you working on Marcus?
3 years with Marcus. So
8.5, 4, great.
And then like for the Happy Money bit, do you want like what we're doing right now, or what Happy Money is focused on doing?
Whatever is most exciting to you.
Okay.
Good?
Yeah.
Okay. Thanks, Alex. So one of my favorite people here, and excited to introduce Nick. Both favorite people personally within FinTech because of the impact that Nick is having. But to give a quick overview and intro to Nick, 8.5 years at Goldman, 3 working on the Marcus product, and then the past 4 years at Happy Money, leading product at Happy Money. So Nick, as an intro, give the audience a quick overview of the impact that y'all are having at Happy Money and what y'all are up to.
Yeah, absolutely. And this is awesome. Yeah, at Happy Money, we're focused on unsecured personal loans. And really, like, one of the things that just makes Happy Money really unique is our source of capital. So we work predominantly with credit unions, which is just really unique, and we've got a great mission alignment. I mean, at the end of the day, Happy Money is all about helping people get control of their financial lives, and our bread and butter is our unsecured personal loan focused on debt consolidation and credit card refinance. So, I mean, particularly with everything that's going on right now in the macro environment, I feel like we're going to be very well positioned to help out quite a lot of people, especially with how much debt folks are incurring over the past few years. And so really we're just getting ourselves situated for scaling back up the business. So that's kind of what we're up to at the moment. So.
Yeah, it's funny. We were talking earlier in the podcast about the fact that in the U.S., we're now at all-time highs for credit card debt, right? And even though that hasn't necessarily manifested as a surge in delinquencies, it's not hard to see that like we're kind of reaching maybe the outer limits of what consumers can handle. When you sort of focus on like the customers and what they want, what drives them to Happy Money? Like, what is the sort of like trigger that like causes them to go, you know what, I need a personal loan. I need to sort of attack this problem in a different way.
Yeah, I mean, so there's like lots of different areas where, one of the things that's beneficial for us working with the credit unions is we can access folks that they typically struggle to access. So we work pretty heavily with affiliate partners like Credit Karma, NerdWallet, et cetera. Really, look, at the end of the day, people are generally first off shopping for price, just being candid around that. But, and then certainly like once they land on Happy Money, in addition to the price that we're able to do because of that partnership with the CUs and their, low cost of capital, it's really, I think, our brand and really the personalization, the flexibility of our product. We're actually in the midst right now of really fully retooling our platform, and we're going to be launching that and scaling it over the coming months. And I'm really excited about it because it's more flexible. It's also more personal. And so, really, we want to see the whole person. We started with this. We were one of the first to get into cash flow underwriting several years back. Yeah. Since then, we've just kind of leaned in. We look at FICO as, less than perfect. And so we try to look at lots of different alternative data, behavioral data as well, just to get a better understanding of ability to pay, willingness to pay. And so, ultimately bringing in new members for our CU partners to drive their growth going forward, but also obviously to help the members going back to helping them, improve their financial wellness.
Yep. So. Yeah, love that. There's so many things to unpack there. But two main differentiators that I see on the Happy Money side is what you all do on the origination side from an underwriting perspective, and have built what I view as truly revolutionary models to be able to understand creditworthiness outside of a credit score. But the second that we've spoken a lot here about at Strategic Advisory Board is your approach to personalize, flexible, meet the member where they're at from a servicing and collection standpoint.
Yes.
Dig into that a little bit deeper of the impact that y'all are having there and how that helps drive value for your members and for Happy Money.
Yeah. So, honestly, I look at our contact center or operations as the heartbeat of our business. I mean, at the end of the day, they're the ones who are on the front lines talking to our customers every day. As much as I'd like to be doing that more often, they truly are the face of happy money to our customers. And so we've been investing a lot in our back office and our operations over the past 2 years, really, rebuilding it, kind of with the mindset that if your back of house is happy, and running and humming along, then that's going to translate to the customer experience. And so, that's really something that we've been focusing on. With collections, we've completely overhauled that over the past year and a half. Part of that was through the tech. We simplified our stack, consolidated onto one platform. That gives us like a ton more data just to improve our processes and improve the experience, but also to create a more tailored outreach engagement, particularly around collections. Collections is hard, and we do our best to lead with empathy. That's not just important to us, it's important to all of our capital partners as well. And at the end of the day, it's showing members respect and meeting them where they are, and going back to like looking at the whole person. So, whether it's our outbound campaigns, and we've been trying like lots of new strategies to engage the members, and, engaging somebody who's early in delinquency versus like very late in delinquency is a very different experience with different tactics that are required. But we're continuing to tinker and refine, especially as we get ready to launch the new platform.
So digging into that just one layer deeper, I think the other thing I'm curious about is how you think that experience might evolve or change over time. And one of the things Colton and I were talking about earlier is this idea that like we have different data and different capabilities than we used to, right? And like I was sort of pitching Colton on the idea of like cash flow servicing as opposed to cash flow underwriting. But this idea that like on a personal level with consumers, you can have a pretty good insight into like what's going on with their cash flow, what's going on with their personal financial situation. This idea of like getting someone in pre-delinquency, which is also known as just being a good customer, and maybe you're having a problem or maybe you're not. So how do you think about like how that might evolve over the next couple of years?
Yeah, so actually that's something that we have been spending some time on,
sure,
particularly over the past 6 months to a year. And it's something that we really want to lean into because like essentially building a risk indicator, looking at their performance over time. We also we consolidated everything onto Genesis over the past year as well. And with that, we get transcripts across every form of interaction. So whether it's a call, a web chat, SMS, etc. And so one of the things that I would like to do is really harness that data. Today, like our QA agents can only really scratch the surface with looking at those experiences and then taking that and feeding it back into our product organization, back into ops, etc. to further improve things. But if we can harness this using things like AI to really like pull the themes out of it, not just for what the members are looking for, but also for how the agents are interacting with the members, for how we can do things better. So being more proactive with those risk indicators, but then also just taking better advantage of the data to just to continue to learn more and to refine. I'd say the other thing that we're focusing on is self-service. And like, honestly, like, look, at the end of the day, if people don't have to call somebody, that's ideal. Like they just don't want to do it, and it's more efficient for us. So our old platform, it was challenging to get those tools out there at the speed that, and honestly, even to, hold on, to get it out there, essentially to be with parity with the market. But at the end of the day, working with LoanPro, we think that we're going to be able to ship more self-service tools to our customers much faster over the course of the next year. And so that's just something that we're going to continue to lean into.
Love that. One of the aspects I want to drill into that you mentioned at the beginning is personalization. I have a big belief and premise that credit and lending and overall financial services, the more personalized, it's driving towards a more personalized experience towards that end customer and who that is. How are y'all approaching that? What do you think that looks like moving forward when it comes to lending and credit?
I mean, it's definitely not just one thing that you've got to do. Certainly part of it is through what we're doing with our embedded finance as well. So we built out our API platform so that we can embed our products elsewhere. and make sure that our brand partners that we're working with can layer that experience onto our products as well. But then we're doing some things that are really fundamental to, like chosen name is something that we're implementing in our new funnel as well. And so, really, again, just looking back at the whole person and, as it pertains to legal docs and things like that, obviously we can't use it in those places, but anywhere where we can create that personalized experience in the UI, we want to do that and really lean into, again, just seeing our customers for who they are and how they identify. So, those are some of the ways that we're doing it. And then in terms of the actual product itself and personalizing that more, we're giving more flexibility around the offers. And really even deep into our funnel, you can switch it really up until the last minute, up until e-sign. And so just an understanding there that there may be more flexibility, you may be changing, your intent a little bit as well. And so giving more flexibility with our product on that front.
So I'm curious real quick to dig into the credit union part of it, because that is unique, right? And I think that there are a lot of sort of challenges on the surface to working with credit unions, which can be related to field of membership. There's all kinds of surface level challenges that make them a little trickier to deal with in some ways than banks. But I think it sounds like this has been your experience, that there is sort of an underlying mission alignment with credit unions that just is different, right? And I used to sell to credit unions a long time ago, and the first piece of advice I got to credit unions was always say member, don't say customer, and it's really, do they really care about that? And it's no, they take it seriously. They really care about that. And, I'd love for you to sort of elaborate a little bit on, from the credit union partnership perspective, where the alignment is with Happy Money and what you guys are doing, and how this fits into their larger strategy for how they serve their members.
Yeah, so I mean, if you think about credit unions, a lot of their business is indirect auto, right? And so in a way...
We were talking about that earlier, actually, yeah.
Yeah, so in a way, they kind of view, or, at least historically, they viewed Happy Money's product in a similar vein, which is it's indirect, right? And so they don't necessarily view that member the same way because their primary account isn't with the credit union, right? And so that's something that we want to change. We want to deepen our relationship with the credit unions from a Happy Money standpoint, but we also want to bring that member closer to the credit union too. And so that's something that we're going to be leaning into hard with our new platform. And so one of the ways that we're talking about doing that, and it's a pretty simplistic thing, but leaning into the specialty of the credit union and also our mission, potentially working with MSU, FCU, Michigan State University Federal Credit Union.
Yeah, they're great.
Awesome. April and Sarah are fantastic. And one of the things that they've really focused on is financial literacy.
Yeah.
And so they've got this full library of content, essentially. And so, right now that's something that we've talked about offering for years, and we haven't necessarily done that. So really surfacing that content to our members as well as a potential way to do that. But also there's the member side, but there's also what does a credit union need? And so we built a platform several years ago. We call it Hive, and it's focused on loan participations. And so, I certainly didn't really know about loan participations, but
it's its own whole niche world, man.
It is. But yet I had to, lead the effort to build that. And so, it was a fun thing to go figure that out and what's really meaningful to the credit unions and how we can get them more leverage. And so we built this so that we can do fractional sales, whole loan sales. Sure. And that's really important because some of the credit unions, a lot of the larger credit unions, they do have ways to have nationwide field of membership and an open field of membership, I should say. And so, that has been, but at the end of the day, some of the smaller credit unions, they have a very homogenous portfolio. It all looks the same because of their field of membership, and it may be regionally restricted. And so being able to participate loans and diversify their portfolios, their asset types, that's something that we really want to lean into and help them with as well. So that's something that, over the coming year or two, we're looking to really lean into as well and ramp up as we bring on more capital partners onto the platform and look for ways that we can help them solve problems that it's just, not necessarily their expertise, but have been pain points for them historically. So those are a few different ways that we're looking to work with them. But at the end of the day, it's going to be a fundamental piece of Happy Money and how we'll continue to grow. We may look at other types of funding for capital as well, just to build more resilience and diversity in our capital supply. But, I see the CUs as being fundamental. So
we're in the Salt Flats, so wind is going. I freaking love this so much. I've got one last question that I need to ask. One, love your background. We mentioned 8.5 years at Goldman, 3 of those years at Marcus, working on the Marcus product, 4 years building product at Happy Money. Take a step back, look at that broader experience. What are the key insights, learnings that you take when you think about launching a successful lending or credit product and what it takes to do so?
One of the things that I think, that's a good question.
You can take your time too, because we can cut it.
Okay. Honestly, like one of the things that I feel like we end up doing is we look at the problem really downstream. You look at the collections problems and there was a lot of fixation on collections, delinquency, recoveries, all of that, but you're so far down at the end of the process at that point. I really think that our key to success going forward is how do we tinker, improve, or just straight up overhaul what we're doing way further upstream to improve those things. And so that's been something that's really fundamental to what we're doing with our new funnel that we're going to be launching. We've made a bunch of enhancements, not only to drive efficiency with our operations teams that's processing these applications and to process it in a way more efficient and timely manner, ultimately leading to a better experience for the customer, but also for a way to make sure that we are getting a holistic view from a fraud processing, credit risk perspective. And whether it be through our partnership with LoanPro or partnership with Ocelar, being able to pull in more sets of alternative data to further refine what we're doing. I think that's really going to be the key at this stage of the game. And so, continuing to work with our risk team and leadership to refine that strategy, I think is something we'll focus on over the coming year as well.
Well, Nick, you're preaching to the choir with that stuff. So we appreciate you coming on the podcast. Thank you.
Thank you so much.
Thanks, Nick.
All right, Colton, actually we have 2 guests joining us for this time. Please give us some introductions.
Yeah, 2 is always better than 1.
I
so
totally
excited
agree.
to dig in. We have Kamal and Anthony here from Golden One Credit Union.
Yep.
I'll let y'all introduce yourself quickly, but Kamal and Anthony, I've really got to know you over the past couple of days, are building out small business banking at Golden One as a practice and doing some really incredible things we're excited to dig into. So please quickly introduce yourself and give a few words on the impact you're having at Golden One and what you're doing.
So yeah, Anthony Riddle, Director of Product. Been with Golden One for only 7 months now, but we're really excited to build business banking and hit the ground running. So
yeah, and I think credit unions have been entering the space of business banking, small business for some time now, and Golden One's one of the largest credit unions in the nation, and so we have this opportunity to build it out in the way we want to, and it's exciting. And I would argue that in certain ways it's harder to do than a startup, because you're working with legacy people that don't innovate and have always done the same thing some way, to encourage them to think differently. It's okay to fail. It's okay to have a 80% correct MVP and improve on that. And so we're launching 10 products and services hopefully this November, and then expanding into lending, lines, merchant services, and commercial lending over the next years or a couple years.
So you brought up one thing that you got to chime in, and it's going to be the premise of our conversation. Kamal, how long have you been at Golden One Credit Union?
Only since December last year.
Great. So
Yeah.
December last year, and you mentioned that you're launching 10 products in November.
Yep.
About a year since you've been there, really kicking up the practice.
Yeah.
And excited to dig into more about how that's possible at a credit union, where credit unions and banks generally move at a slower pace, and how you've been able to actually drive kind of fast innovation to market.
Yeah, I think it's about visualizing the future and what it could be. Credit unions have always been, kind of traditional, and they want to grow. And I think there's a shift change, especially in the small business space, that there's now a big consideration for credit unions to provide business services as part of the community, right? And if you look at some of the Borrowell research, in California, the big three banks, Chase, B of A, Wells Fargo, are actually losing share in California, and credit unions as a whole is actually gaining share. And we want to capitalize on that and bring together the products and services that you would get at a big bank right here at a credit union, part of your community.
So one of the things I'm really interested on that front is I've seen a lot of survey data, both on the lending side and on the banking side with small businesses particularly, where there's kind of this strange dynamic of, in the moment, when a small business owner is trying to solve a problem, they want to solve it like right away, right? And I earlier in a conversation, I shared this idea that like small business owners are just very time constrained, right? And so like, I need to solve this problem. I've in the past analogized them to like new parents, where like you have a baby at home and you're like, how do I keep this baby alive? Whatever I have to do, I'll do. And you don't always make like rational decisions when it comes to like keeping your baby alive. And so there's this like urgency that drives decision making. But on the backside of that, there's also this like longer consideration of like, who's a good partner? Who do I want to work with, right? And what this tends to manifest itself in is a lot of times small business owners will work with fintech companies or new entrants because they can meet that experience requirement, they can meet that speed requirement, like they can give them what they need in that moment. But then you survey those same small business owners later, and they will tell you that the experience they get working with a community bank or credit union is significantly better than they get working with like a fintech company. And so I'm curious for you guys, sort of trying to meld that like MVP fintech type experience with the service and sort of membership focus of a credit union. Like, how does that manifest when you're designing these products?
Sure. At the end of the day, it comes down to cash flow. So in the small business space, cash flow is what keeps them up at night, right?
Yeah.
If I get paid from a vendor or from a client and I deposit it and it's not there on Friday and I don't pay my employees, they're leaving and I'm done.
Yeah.
Right. It's that critical.
Yeah.
And in the business banking space, let's say 2 to 20 million, cash flow is still important, and they're optimizing how they move cash around. When you get into commercial banking, that's a whole different category.
Yeah.
And so what we're really solving for is making sure cash flow is there for them.
Yeah.
And a lot of banks think that the relationship manager is their trusted advisor in the small business banking. That's not true at all. Mm-hmm. What they're really looking for is an advocate. Mm-hmm. Help me navigate the bank and the products that optimize my business. If you can provide that service, that's when you can win.
Yeah.
Yeah. I love that. Go ahead, Anthony.
No, I agree. It's about having the right people in the right places to help answer questions and serve and be a trusted advisor to the small business. So I agree.
On that note, there is an opportunity to drive product innovation for banks and credit unions that already have trust in a meaningful way.
Yeah.
One of the aspects that I've seen, I started in fintech about 6 years ago, 5-6 years ago. And one of my first jobs was to go travel the U.S. and go visit banks and credit unions. Yeah. One of the things I would ask them is, what are your strategic priorities? What does that look like? 5-6 years ago, people were talking about small business. Huge opportunity, small business, I want to go capture it. However, to this day, most of them have not really done anything within small business banking.
Right.
Why? And like, what's holding people back from capturing the opportunity?
Well, a lot of times most big banks think small business is like consumer, and it's not. And I'm a big proponent of physical distribution and human interaction, especially in this space. In my previous roles at some of the major banks, digital only doesn't work. Like you open a checking account, the average balance $5,000, and they close it in 3 months. When they come to a physical channel, they buy more than one product, $25,000 average balance, and they stay for a year. So which one do you want? So what we're focusing on is how do we leverage our physical channels supported by digital strategies, right? And so emulating a high-touch experience with the digital online application, making it feel like the person at the branch or an RM is helping you through this when it's really all digital in the back end. And I think that is a winning differentiator. You know, one thing that most fintechs wish they had was physical distribution.
Yeah, I've joked before that if fintech companies could like magically like just pick a branch that a traditional financial institution has and just be like, this is our branch now, all of them would take them up on it, right?
Yeah.
Like it's an advantage to be able to interact with your customers, you know, or your members face to face and be able to have that relationship. I guess the other thing I'm kind of curious about is how you see this sort of changing nature of how small business owners manage their finances, right? And manage their sort of overall business. Because I think one thing that's a trend I've been paying a lot of attention to is this idea that there's just a lot more software for small businesses than there used to be, right? And one of the stats I've heard that is kind of a wild one is the average small business owner uses 10 different software tools to manage their business, right? And so like, it's a lot, and in some ways it's nice because it's best of breed. You get to like do this thing for invoicing and this thing for inventory, and you have all these different things. But I would imagine that small business owners, again, they're like time constrained. Like they don't have time to manage all of that. How do you view your role in like bringing things together and making small business owners' lives simpler?
You want to take that? Or
I think the dynamic product selector is something to talk about. You should talk about.
Yeah. So two things. So first, you know, you're hearing about all these younger millennials taking over their business, right?
Yeah.
Mm-hmm.
But at the end of the day, if you ever, and I encourage all of you to go spend time with a small business. And I went to a noodle shop in Chinatown in Oakland, and you looked at their workflow and how they manage cash flow. It was Post-it notes, right? And maybe a little QuickBooks and Excel here and there.
Right.
But they've got it nailed down. That's how they manage their business, right? And then now their sibling or their children are coming and take over the business. They're not changing that.
Yeah.
Right, because they know how it works.
Yeah. It's a system.
So now, if you say, "Hey, I've got this online tool, I got all this," they got to change their workflow, and that's really hard to do.
Yeah.
Right. So this idea that once they have it set up and you're dislodging that process, that's a lot of work while they're still running their business.
Yeah.
Right. And so, I think you know, back to your question on how do you help them? It does come down to cash flow and credit in relation to cash flow.
Yeah.
And you know, like this, it's hard to say. Like some clients want a digital interaction and some don't.
Sure.
Right. Like when I go to the grocery store, right? I hate the self-checkout one.
Oh, yeah.
That's the digital channel.
Yeah.
I don't know what the code for broccoli is, right? I like to go to the line and have them do it for me. But when I go to the gas station, I don't want to talk to anybody. I'm all digital.
Pump and go, yeah.
Yeah. And so you got to meet them where they want to interact.
One, don't go to New Jersey because they have to pump the gas for you.
It is a weird experience, too, by the way. It's very strange where they're like, nope, don't get out of the car. Just stay there. We'll do it for you. It's odd.
It is very, very odd. Yeah, the only state where that's the case.
Oregon also.
Oh, Oregon also.
Oregon
I've
also.
learned something new every day.
It's a weird thing, yeah.
Along those lines, you mentioned this, but y'all have been there about a year, launching 10 products this November within that year time frame. So obviously a big goal of that will be to drive increased share of wallet. It's not just like, hey, I have a small business and I have SBA product for them, or I have their deposit product.
Right.
We've chatted a lot today about how to drive differentiation to increase share of wallet. How do you think about the member experience in the small business to then drive greater share of wallet and adoption of other products?
So I think about it like Taco Bell, right? Okay. So their lead generation product is the 99-cent bean burrito, right? That gets them in the door, the drive-thru. But when you get there, you're presented with the value meal, the chalupas, the fries, and that's where all the margin's made.
Yeah.
But you can get the bean burrito, but once they leave, it's really hard to get them back in the door to buy the rest of the stuff. So you have to build your product and offering at point of sale. So they're in a buying mode, right? And so, for example, we spend all these dollars and monies for banner ads to get visibility and clicks so they can see a product. But when we're walking into the branch where you have a captive audience and they're in a buying mode, if you don't take advantage of that, you blew an opportunity.
Well, the other thing that I think is kind of interesting, again, about small business, and you mentioned this before, is this idea that people sometimes treat it as like, oh, it's just like consumer, right?
Yeah.
And it's not just like consumer.
And it's also not like commercial. They're very different in both ways, right?
Exactly. And I think one of the things that is so interesting about small businesses, in some ways they have more of a consumer sort of perspective in that, like, there's a lot of them, they're small, you have to sort of, it's more of a volume business in some ways. So not like commercial where it's more bespoke, but I think the big difference between consumer and small businesses, one of the big differences, small businesses are so unique, right? Like they're all very different from each other. Mm-hmm. They all have different cash flow needs, right? Like if you're a ice cream shop in Maine, you have a very seasonal business just by the nature of what you're doing. How do you think about like adapting to the needs of different categories of small businesses and like making sure that your product is fit for purpose despite the fact that small business is not a homogenous group with just one type?
Yeah.
Well, I mean, that's a good point. You could have two identical companies in the same industry, let's say tire stores.
Yeah.
And their cash flow needs are completely different.
Totally.
Right. So this idea of doing it by industry verticals never work.
Yeah.
Right. Except for maybe, underwriting. But it's really different, and you've got to adapt. And I think Anthony was talking about what we created is this dynamic product selector, which are 4 basic questions like how do you receive checks, Apple Pay, a POS reader, and Venmo, or how do you spend? I spend with credit cards. Some of my employees use a credit card to pay for fuel for the trucks.
Yeah.
And then I'm buying equipment, and you might need an equipment loan or SBA loan. In layman's terms, triaging them together and like, here's what their basic needs are, takes less than 30 seconds to get that through a tool that we use. And then we can categorize them and create dynamic offers that earn the business all at point of sale. So that's what we're shooting for. And this idea of moving away from products to solutions. So when you apply for a checking account or a card, it comes with a checking account, merchant services as a package that you already have. You just need to activate it.
Right.
And that's where we're moving towards, away from individual products.
Love that.
Mm-hmm.
Lastly, I've got to ask, we've mentioned it several times, y'all have come into the credit union and truly drove innovation. There's lots of folks within banks and credit unions listening today trying to do the same thing, hitting roadblocks and struggles. What advice would you give? What does that look like? What's the secret sauce? What advice would you give?
I think it's hard, right? We're working with legacy systems and legacy mindsets also, right? And you're going to hit roadblocks, right? There's going to be a lot of challenges, a lot of bumps in the road, and you have to have a plan, right? You have to know how to pivot, and so I think that's really important. I think that you just have to keep pushing. You have to drive and get it across the finish line.
And not get discouraged.
And not get
keep
discouraged,
going.
right? Keep going.
Yeah.
Right.
And culture is a big deal. Even in large banks, right? It's hard to innovate because each, like merchant services, lending, has their own P&L, and they have no interest in combining stuff together because they have their own goals that they're going to meet. And by putting things together and organizing, that's not helping them meet their goals.
Right.
And so I would argue it's even harder in like a Wells Fargo or a US bank to innovate.
Yeah.
No, I couldn't agree more, and it does paint an interesting picture of the future of kind of who's going to win and who's going to lose in this industry. We could go on and on about this, but we'll let you get back to the fun. Thank you guys so much for joining us.
Thank you. Thanks for having us.
Thank you.
Thank you.
All right, so Colton, we have one more guest, and we saved the best for last, so introductions.
We definitely saved the best for last one. Greg, last night, we did some awards last night at the welcome reception, and I was talking to Jerry, our Chief Customer Officer. I was like, Greg deserves, and hopefully it's okay to say this, the Get Shit Done Award.
It's totally fine.
And it was a slightly different award, but I really want to give him the Get Shit Done because I have not met another person within financial services or fintech that truly finds opportunities and goes straight towards it, captures it, is in the details, understands the strategic vision. So Greg, excited to dig in. Thank you for being here.
Thank you. Me too.
So Colton was sharing a little bit about what types of things you work on, and servicing obviously is core to kind of your function, and I think probably like the way you look at like value in the market and stuff. So I'm curious, maybe to start, can you give us just a little bit of like your philosophy for how you approach servicing a portfolio and like what's important and like what goes into that? Because I think it's not treated as an art form by everyone, but I do think there is sort of an art to it. So if you could kind of walk us through that a bit.
Yeah, so actually it's an interesting question because servicing is largely an afterthought.
Totally.
If you think about how most fintechs or, digital banks that do a lot of lending or digital lenders, it is originate, let's find the most efficient, consumer-centric way to originate, let's get them in the door, we're going to turn around and we're going to sell this asset as quickly as we can, and then, oh yeah, they're still here.
Right.
But we don't care because they owe us money, they signed a contract, and let's just keep going.
Right, as long as they're paying, we're good.
As long as they're paying, we're good. And the fact of the matter is a lot of lenders and servicers focus on as long as they're not delinquent.
Yes.
And when they go delinquent, how do I fix that?
Yep, in the most operationally efficient way possible.
That's right.
Yeah.
Now, this is absolutely true, and you'll know this when you talk to consumers. And actually, my last gig, we built a product specifically around this. Once they want what they want, and oftentimes there's a little bit of buyer's remorse whenever you get a loan. For 6 months later, you're like, damn it, did I really need that ATV?
Yeah.
I mean, I love it, but did I really need that?
The wife isn't thrilled with the purchase.
That golf simulator was awesome. No, but you get it, and then you're in it, and you're like, shit, how do I get out of this?
Yeah.
And so you're trying to figure out a way. And what do we as lenders or loan servicers do to help borrowers get out of debt? And the answer is nothing.
Yep.
Almost nothing. And I think there's a shift. It's slow, but it's happening, where lenders and servicers have the opportunity to give more self-service opportunity to a consumer. Now, this is counterintuitive because me as a lender, I want you to pay by the letter. I want you to pay on time, not early, every payment, the whole time. I want to take the entire lifetime value out of that, and I want to earn as much as I possibly can. If you pay off early, I have a shorter wall on the loan. Make my F&B goes down. Whatever else, I can't sell it for as much. So if you pay the entire time, it's great. But what largely is going to happen is you're going to go online, you're going to find some amortization calculator, you're going to type some stuff in, and you're going to start trying to figure out how you can pay this off early. Or you're going to find another lender that's going to be able to refinance it out, lower rates are going to change. And so the question we have to ask ourselves is, how do I build, what can you do with servicing to make it valuable? To not to the consumer. Yes, that is the end goal, right? But what can I, the goal has to be, the focus for an institution has to be, what can I do to make this servicing experience valuable to me? And the thing you can do most is help the consumer, help the borrower. And the way you help them is help them get out of debt. And it seems really, really counterintuitive. How do I help you get out of debt? And there's really simple ways we can do this. You can give them easy calculators. What happens if I pay an extra $50 a month? What am I going to do and save an interest and save on time on my loan if I pay an extra $500? What am I you can give all these kind of scenarios that you can easy little calculators we can put inside of our servicing platform. You give self-service. I think you talked about someone doing this on LoanPro. Self-service ways to get financial support, hardship programs or other things. Help them help themselves through that system. And while you're helping them get out of debt or you're helping them get a hardship, you're messing up your financials from that kind of perspective. The question is, when I come to refi, and what are you going to say, 50 bips? And you're going to go back to what? Just a spreadsheet online where you can't do anything and the lender doesn't give two hoots about you? If you can create that kind of servicing experience, you essentially lock in your borrowers because they don't want to go somewhere else. They no, I trust them. You have their loyalty. They're going to help me. They have already given me self-service capability. They're teaching me how I can pay off my loan faster. They're giving me all these things that no one else is going to do. And I think that is an untapped value for a huge portion of lenders.
100%. One of the things we've seen on the LoanPro platform with several of our customers is, and they don't see this immediately because it takes a little bit, but some of our customers that have been on the platform 7-8 years have started to see an increase relative to where they were before in repeat borrowers. I do unsecured consumer lending, and I gave you an unsecured consumer loan 5 years ago. You paid it off 2 years ago, and you come back to me. And you're way more likely to come back to me because of that experience. One of the other aspects we've chatted about is proactive versus reactive servicing. Give us your thoughts on how you enable an organization both culturally and technologically, made up a word, but from a technology perspective, to be proactive in what they're doing in servicing and collections?
So we were talking about this a little bit last night. I think this is an interesting question. First and foremost, the organization, and we just did this at it's like you have to instill the founder's mentality in your entire organization, which essentially puts the customer first. Yeah. The front line is super valuable, and it's not just putting the customer first, but empowering your front line to be able to handle the issue. We actually talked about the story that was shared was it was on Oprah apparently. This woman took out a loan from Capital One to go for her honeymoon or something like that, and the wedding didn't happen, so she wasn't going on a honeymoon. She called, like, we'll cancel the loan, no problem, whatever we need to. Yeah. And then the agent that took the call sent the woman flowers.
Wow.
Right?
Yeah.
Oh. The woman called back and said, hey, will you go on my honeymoon with me? Took her to Hawaii. They're best friends to this day. I mean, that's how it ended up. It was big news. That's how it ended up.
That is a great story.
But Capital One had empowered their agent to like, here's some slush money. Like, do something nice for people to have. So taking care of them right there, like that's not necessarily addressing the product, but empowering your front line to be able to have that ability to make a decision is really important to meet that servicing. That is more on a like reactive basis. They're coming to me. Sure. I have the capability, I have the empowerment to do it.
And I don't need to transfer to my manager and my manager's manager who needs approval on a million.
Just going to solve your problem.
Right. I can solve it right here, right now. Because we know, number one, in customer service, it doesn't matter if it's a bank or an airline or if I have to get transferred through 3 people, I'm already pissed off.
Right.
Like, it doesn't matter if you solve my problem.
It's
I'm
a loss at that point, yeah.
You're going to solve it, it's great, but like, no, I'm annoyed.
Yep.
The other one on the proactive side, I think this is really interesting, and it's really interesting for institutions who have multiple products. So you have their checking, their savings, their credit card, their loan. Now, lenders that do cash flow underwriting for SMB do this proactively. I can see that your cash flow is down, and I know you're going to need a working capital line. And I go, hey, Alex, your sales didn't hit the numbers, but I know you're going to catch back up. This is your seasonal dip.
Yeah.
Do you want to take out a working capital line?
Yeah.
So I can proactively see what's happening. We don't do this for consumers.
Yeah.
But with, Mint's gone, but with Plaid and all the other, it doesn't matter. You go Savvy Money. There's a million of these things you can plug in. You can get all their other bank account data. You can start seeing how their total cash flow is. I can see that your cash flow is down and your payment's coming up. Yeah. And you're not getting paid for 3 weeks. I know that because I also have your checking account. I know you haven't gotten a deposit. I should be able to proactively go, hey, do you need some help?
Do you need to skip your next payment?
That's using data to actually drive proactive behaviors. Like, you could tell me that, whatever, at period, month on book 12 with this FICO and this income, whatever else, and this payment behavior and this entry rate, whether they're 5 days delinquent, whatever, they're going to go delinquent on this. But sure, but all I'm really doing is chasing delinquency. I'm not helping a consumer. I'm helping myself to go after this person and actually make their life more stressful. It's not a fun experience when your bank calls you and says, hey, this
be nice to get paid, yeah.
But if you can find a way to frame it like, hey, and that's the tricky piece, is finding out how to frame it where like, hey, by the way, I'm watching how much money you have.
Right.
And that was the whole Target thing where the Target knew the girl was pregnant before the dad did.
Yeah. The big data thing can go a little too far.
It can go too far. So, but if you can find a way to deliver it effectively, and it might be just you find out that their cash flow is low and you send out, you're eligible for a 1 month skip a pay.
Yeah.
Would you like to do that? You don't have to tell them their cash flow is low. You don't have to do anything. That's how you use your data and your insights and everything else to proactively meet a customer where they need it, and you build a relationship that is untouchable.
Well, it's interesting because even when you get into the early stage collections, one of the things that comes up a lot is, again, this operational efficiency mindset where it's like, okay, so which percentage of these early stage, sub 30 days or 30 days plus, delinquent customers are going to self-cure, right? And we're going to run this very complex set of analytics in order to figure out who's going to self-cure. Oh, we've identified these people. We don't need to waste any resources reaching out to these people, which is a very operationally efficient mindset. But I think the flip side to it that's really interesting is, you might be able to do some good for them and for your relationship with them by reaching out to them anyway. Like, yes, they're going to self-cure probably. That's great. Your payment flow is not in jeopardy. That doesn't mean that there's not an opportunity to build trust with them if you were to reach out to them when they have a problem.
Perfect example. I have a rental house and renter's late on rent or whatever else.
Yeah.
Now, I know when my mortgage is going to be delinquent. I think I have a 15-day delinquency on my mortgage, so they're 5 days late. I don't care, whatever.
Yeah. Sure.
I can pay it or I can wait for their payment to come in. But if I'm 5 days late on that mortgage and my mortgage lender reached out to me and said, hey, this is not a call out, just want to let you know, you'll be reported delinquent once you go 15 days delinquent.
Yeah.
Not saying anything, just so you're aware, this is the grace period you have.
Yeah.
Because no one knows their grace period.
No
one read the loan agreement. They don't know. But to your point, like, hey, this is a self-cure.
Yeah.
But just so you know, and then you have to know that, hey, I sent this to them once before.
Yeah.
I don't need to send it to them every time.
Yeah.
And it goes back to a lot of lenders will measure portfolio performance based on credit losses or delinquency. A lot of what I'm seeing is a lot of lenders look at engagement instead. How many times am I communicating with my borrowers? How engaged are they with actively servicing their account, what that looks like? How when they call in, how fast are we resolving their calls and things like that? And those are pre-indicators of what eventually turns into delinquency.
Yep.
Yeah.
The other thing that I've been sort of noodling on and would love to get your take on is I think the nature of the product itself changes the way you approach some of this stuff, right? And so, I think a lot of times what I see from lenders is when there's a very established like loan product type, you have this like rhythm or this sort of operational like playbook that you build around, here's how we service this portfolio and this type of product. But I think one of the things that's sort of breaking in fintech and in banking and credit unions is there's a lot of innovation in lending right now, right? And so you introduce things like buy now, pay later, you introduce new types of like short-term lending products, and I'm guessing that applying the same servicing playbook to novel or new types of lending products isn't always necessarily the best approach. Like, how do you think about, as we innovate on a product side, how that ripples into lending?
I think you're 100% right. When you said that, the immediate thing that popped into my head was familiarity breeds contempt.
Yeah.
Like, we get so used to the routine, we just,
Yeah.
it happens, like, you can drive to work and, like, did I drive here? I don't
Yeah, I actually don't remember
the
Where
drive.
did I park?
Yeah, exactly. Like, you're so used to it, it's just such a rhythm and a routine, you don't even think about it anymore.
Yeah.
But when you layer on something like a pay in 4,
Yeah.
right, and it goes from, what should be it's a 4-month installment loan.
Yeah.
But you can't treat that 4-month installment loan like you can treat a 4-year installment loan.
Totally.
Like while the risk profile, it's like $500 or less or $1,000 less or whatever you did, like the borrower that's taking a pay in 4 is a different borrower than the one that's taking out a $30,000 for a 48-month loan, right?
Totally. Yeah.
And so I 100% agree with you that we have to figure out ways where the systems and the mechanisms and like the tools we have are reusable, but the patterns or like the delivery timeline or the simple as much as the messaging and the content changes because it's not the same.
Yeah.
And like it goes back to the proactive or reactive. Like, are we personalizing the content? Are we personalizing what we're saying and how we engage to the consumer in a way that meets them where they need to be?
In a way that we're using data in the right way too to inform that personalization. Greg, as we wrap up, you were one of my favorite people, period, but also in fintech. And you have a long career within lending and credit, what that looks like. Advice, insights as you step back and think about what actually drives success in a successful portfolio within lending and credit?
Ooh, that's a big one. I think it's going to change depending on what your business is. If you're a digital unsecured lender, then the biggest driver for your success is top of funnel and your risk and pricing, right? If you're talking about like an established organization that's already running and how they can improve, I think one thing that's getting harder, and I think we collectively as financial institutions and fintech partnerships and whatever else need to find a way to break, is an institution's ability to launch new products or shift from what they do. If you're a mortgage lender, you're a mortgage lender, you're a mortgage lender, you don't do personal loans. Maybe you do, but you probably do them really shitty.
Yeah.
Right? And you only do it because your customers are asking for a home improvement loan after they got a mortgage. And you said, oh, look, there's free money there. But that shouldn't be the default mechanism. Or you're, an unsecured lender and you want to get into auto, or you want to get into something else, or the pay in full, some way to split things up. I think it's a real challenge because, quite frankly, the skills are different for each one. I don't think you can particularly pop out a mortgage lender and make them a credit card, be able to run a credit card portfolio. They're completely different.
Yeah.
Same thing with credit card to unsecured installment. Same thing unsecured installment to auto. There's differences in each one of the way you treat those and the way you work with it, and it's okay. It's fine. But as an institution, we have to open doors and we have to find paths to do that. And the tighter regulations get, the tighter, oversight gets in terms of banks and the CFPB and FDIC and NFC and all the regulatory bodies saying, make sure you're doing X, Y, Z. There's going to be a world very soon where before an institution can launch a model, it has to get regulatory approved. I 100% see it, especially with the the prevalence of AI and machine learning and sort of models. You're gonna have to go in this world where you didn't do it retroactively, you did it proactively, and you might have checked, but you need to be 100% dead on, and the ability to take that skill and move it across different verticals gets harder and harder and harder because you, by default, with more regulation, you have to get more specialized, and I think finding paths for lenders to be able to diversify and not become, one-trick ponies is going to be really, really important.
Well, that is a great place to leave it. Greg, thank you so much for carving out some time for us. This was awesome.
Yeah, my pleasure.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.